My name is Ian Walsh, and this is Masters of the Market. As you know, what we do here, I'm doing interviews with some really, really experienced and expert people in the local Philadelphia market that have a very distinct niche in what they do, and they're very dominant in our market at what they do. And I figured I'd seek them out, put their information in front of you so you can hopefully learn from it. And today I'm joined by a longtime friend in this business. In fact, one of the very few people over time that you'd say, hey, he's a very genuine friend. In fact, he's doing this today with no caveat, doesn't care about the marketing. In fact, he said, don't worry about contacting me. I got nothing to sell. He's doing this because he wants to help, and that's the kind of guy he is. Justin Turner is his name. Thanks for coming on, Justin. I appreciate it.
Thanks, Ian. Good to be
No
here.
problem. Yeah, I'm glad you're here. And Justin's specialty, I mean, back in the day, we kind of got started into business almost at the same time. Now, the difference between me and Justin is that Justin is probably the smartest guy on the eastern side of the United States. So he had a severe intelligence bump over where I started. But he comes from a background of effectively Wall Street and algorithm trading, and numbers are very, very, very relevant to Justin. He has a very unique ability to remove the emotion from a decision in a logical basis, as well as be very fair about the humanity side of it. It's just his approach. He's a very easygoing guy. And his specialty nowadays, so Justin, I mean, we've gone from single family homes. You've built a very, very large portfolio. What are you doing now? Like, what have you guys grown into? And every time I talk to you, it's something more spectacular.
Well, I'd say our specialty now is deals total project size from 2 to 10 million,
Okay.
and we still focus on residential. So it's mainly apartment buildings or apartment buildings with some retail component to them.
Okay.
So yeah, we grew from doing small single family rentals in the neighborhoods that we could pick up for cheap with cash, to doing larger apartment buildings.
Gotcha. So Justin's got an interesting story. I like where I remember watching one of his presentations. He had done a presentation for a local event here one time, and I said, it was one of the presentations, the networking events I go to. I was very particular to hear everything you had to say because the information was so fantastic. I remember your original story. I mean, you started where everybody else is. You had a property that you went in, you swung a hammer, and that's what you did yourself. So everybody starts in the same place, right? It's about the decisions you make along the way, which kind of brings me to my first question. And actually, I really want to know what your insight is to this, as I think we talked about it individually at one point. But, in 2008, we got in at the bottom of the market. Our market crashed. You and I got in, learned what's going on. We're clearly heading somewhere near a top. I don't know if we're at the top, but what have you seen and what are you seeing since 2008 until now in your world of, what you do?
Yeah, there's definitely been a big shift. Obviously we had that big crash in 2007, 2008, and I guess one of the big things that changed, a lot of lenders went out of business, and a lot of those that didn't got hit hard by auditors and tightened up a lot. So in 2008, it was a lot tougher to get financing, and so because of that, I think prices were lower. There were just less available buyers, and that's kind of done a 180 shift. Now it's gotten very easy to get financing. Appraisals are still a lot tighter than they were back in the day. I mean, when I bought my first property back in 2002, it was multifamily property. It was an illegal rooming house. And the bank never actually walked into the property. They did what they called a desktop appraisal, which I hope doesn't exist anymore. And they just pulled up the address on their computer and assigned a value to it. So that's how ridiculous things were, in the days before the crash. Now banks have gotten smarter. They're more highly regulated, but they haven't had losses in a few years, so they've gotten pretty loose again, and interest rates are extremely low. They're starting to tick up, but they're extremely low. So, we on the big multifamily stuff, we've been getting loans under 4% in some cases.
Wow.
So that's not sustainable. That's changing, and the market's gotten a lot more competitive. So there were a lot fewer players in the market in 2008 than there were in 2006, but it seems like they've come back a lot. Like I was part of a group called New York City Cash Flow up in New York back in the 2000s, and I was working up in New York on Wall Street, and so it was New York natives who were investing down in Philly because things were so cheap relatively that they felt
Sure.
like they were playing with monopoly money.
Sure.
And when I at the peak when I would go to those meetings, there was probably well over 100 people in them. And then after the crash, I mean, it was down to like 4 people at one of those meetings. I only know two of the people out of a couple hundred people that I probably met there that are still in business today. So, everyone got wiped out of the market, who was playing fast and loose, which most of those people were. And now, you've got a lot of new people coming back. A lot of people have had success with uh, building single families, flipping houses, which wasn't very feasible, even 5 years ago. So, yeah, I think it's just a much more competitive market. Did I answer your question? I kind of lost track of
It
your
does.
question.
And where you were going with that is very interesting because, as you're seeing now, I don't know if you've noticed it at some of the groups and so forth. Certain people are coming back in. There's a lot of people going to those same kind of groups. I'm not saying that that's the reason the market dropped, but you're like, hey, certain things start to smell like they once did, and then and you don't know the exact timing of it is. So, but what you do know is it's coming inevitably, right? There's natural cycles, and well, not natural, they just occur, right? So,
Yeah.
the next question to you would be, with your particular business, how are you hedging for that? You know it's coming. I know it's coming. You still have to do business, right? You still have to make money. What are you doing to adjust for your business in the future on that?
I mean, so in terms of the risks that we have in our business, we're mainly multifamily. So I'd say there are two risks. One is oversupply. There's a crazy amount that's being built right now.
Right.
So um, most of it is on the luxury high end. There are a lot of new buildings coming up, but then there are a lot of conversions from warehouses to apartments and that sort of thing going on also. So there's a lot of new units coming on. I don't think anyone has really good statistics on exactly how much is being built.
Mm-hmm.
Um, we also have a macro shift that's going on. So um, in 2007 days, there was a big shift from home ownership to rentals. People got burned, saw what was going on, heard all the horrible subprime stories, and they avoided buying a house. And I think that on a national scale, the home ownership rate shifted 2 or 3%, which is a big number if you multiply it by however 100 million people are in the country. Um, so that bolstered the apartment market because all of those people who would have been homeowners, the young millennials, decided to rent instead. And I think you're seeing a bit of a shift back from that. So you're seeing, some of those people now deciding to go ahead and buy a house, and so that's going to have an effect on the apartment market too.
Sure.
But on the flip side, here in Philadelphia, we've got a lot of job growth. We got some big employers bringing in new jobs, and we also have a booming tech industry, booming pharma industry. So that's going to create more of a demand. So it's hard to say what's going to outstrip what, but definitely the amount that's being built. Developers aren't rational in the sense that they're not making their decisions based on what they're predicting in terms of how many available units need to be filled. They're just saying, "Oh, I made money on this last project. I'm going to rinse and repeat." In general,
Right. Right.
so that's why we get these bubbles. People keep going and going and going and growing and growing and growing until it doesn't work
It's
anymore.
blinding,
And
right?
yeah, so that's one potential issue. The other potential issue is interest rates. So now that the election's over, the Fed is going to start raising. We've already seen like the most relevant metric for investors is probably 7-year swaps. In our case, we usually get 7-year balloons or 5-year swaps. So I know that in the last month and a half, no, in the last, yeah, basically month and a half, the 7-year swaps are up around 60 basis points, so 0.6%, pretty big jump. So interest rates are climbing, and you've got a lot of people who locked in very low rates over the last 3 or 4 years, and they're going to balloon in 5 years, 7 years. So when that happens, if they were too aggressive in terms of their cash flow, they don't have enough of a buffer, then they're going to have trouble meeting debt service, especially if they're having issues with vacancy and that sort of thing. And they may be forced to sell. Who knows? And that sort of thing can have a compounding effect. This person is having issues, can't afford any vacancy, has to cut rents to make sure that they fill their properties. That causes other people's rents to force to drop and that sort of thing. So, it can be a spiraling effect. So I'm not saying we're going to have another crash. It would be unusual for us to have two crashes in the same area of the market, 2 times in a row. Like our last crash before this was the dot-com bubble. Usually you have to have everyone forget how irrational they were before you can have a crash and something again. So I think people still remember pretty well the pain of the last real estate crash. So I think hopefully that'll prevent this, a full crash. But there are definitely a lot of risk factors. Things are, I don't know if you would call them irrationally exuberant yet, but people are definitely hype, and people are definitely making aggressive decisions. So a lot of it is the cheap capital. A lot of it is just people are making money, and they're going to keep tossing money when they're making money. So yeah, I mean that's kind of my thought as to what's going on. In terms of what we do, just be conservative. So we just make sure that they call it sensitivity analysis in business or on Wall Street. So, we just make sure that when we're doing our projects, if rents drop 20%, if interest rates go up 3%, if repairs go up and vacancy goes up, if all those things happen at once, because they usually do happen at the same time, then we want to make sure we're still at least able to cover our debt service comfortably. So that's what we do. Just borrow a little less, be a little pickier on deals, and we're doing less deals, to be honest. I would like to be doing probably 3 times as many deals as I am doing right now, but I have tight standards, and I'm definitely not going to adjust my standards in this market where there is a risk of a crash. If we were back in the 2008 days, I would be willing to get more aggressive because there was just less competition, more deals, especially for people with cash. But now I think it's a more of a high risk time. It's more of a time to stick to your guns and be conservative.
So that's a very, very good answer. We're doing the same in our business. I mean, it's the same thing. It's like you got to make money as you go. You can't adjust how you do business, but your conservative approach, I mean, you're more conservative now, even though most people seem to be more aggressive now. We're probably more conservative, and then, but just to recap some of the things you just said, so if anybody listening or when people listen to this, so the basic terms of what you said in terms of the commercial market or the multifamily market is that right now you guys are locked into really low rates. What you're saying is if people are buying based on those low rates, in 5 years their note comes due, let's say the rate is twice that in 5 years, if you weren't prepared cash flow wise, so if your mortgage was $500 today and you were your rents were just covered at $500 today, and that doubles or even goes up by a third or whatever the number is in 5 years from now, because that's the bank rate, then you're underwater. And if you're underwater over a 100-unit building or a 1,000-unit building, that's unbelievable. That's an unbelievable amount of I can't afford this type thing. That's a basic level of what you're saying, right? So so everybody can understand what Justin was trying to get at there, because he's in that world every day and he sees it and he understands that bubble. And I also agree with you in that, I don't think the next crash comes from the housing market. Doesn't make sense. The scars are still there from 2008. There's definitely people that jump into it, but people feel it. People still feel it. I was thinking about the other day, I don't know if you're aware of, there was a phone call that came in after Trump was elected, and don't quote me on my accuracy of this, but I think it was in India. Well, I know it was in India, but they basically effectively, within a 4 or 8 hour time span, eliminated the cash value of like what would over here would be the same thing as saying, hey, today your $50 bills and $100 bills are no longer have any value. So imagine then there was I guess the theory of it was to prevent corruption because there's so much cash being held from corruption and so forth. But you think about the volatility of a move like that. Imagine that, like that happened in India. If that happened over here and they just eliminated a certain currency, or they just, in the flash of an eye, now your currency is. So I wonder, and I have nothing to base this on other than it kind of makes sense, but a currency, implosion of some sort that could trigger across all markets, right? And that could be something. I'm just speculating, but. To what you were saying is that, yeah, I don't think it'll be in the housing market again. We'll be affected by whatever it is, but I don't think it'll be in the housing market either. I still see people understanding the mistakes they made, and really that doesn't happen in a crash. In a crash, everybody's blind,
Right.
most people. So Justin, I really, really appreciate everything you've done today. I really do appreciate you as a person. I think you're really one of the best people in this business. And, as people know, you asked me, I said, you get the cash in chips on me any day you want, because Justin is not offering or selling anything here. He's not marketing anything. I am. You guys know me. It's Ian Walsh with Hard Money Bankers. So one day Justin will cash those chips in on me, and probably won't actually. He's very a very giving person. But nonetheless, your information is fantastic. I could probably spend days speaking with you because you just unbelievable amount of information. So I appreciate you coming on, Justin, and thank you very much.
Great. Thanks, Ian. Thanks
All
for
right,
having
have a
me.
good one. Yeah.